Okay, let's talk CFDs. So what is a CFD? What are CFDs? Well, CFD stands for contract for difference, and it's ultimately exactly what it says it is. It's a contract between you and your broker agreeing certain parameters about the trade that you're about to take. Now, obviously, a CFD is something that you're using to trade individual stocks, shares, equities, currency pairs, forex, commodities, or a basket of stocks like indices. We'll go into a lot more depth of this, but just broadly speaking, let's get a grip on exactly what it is. So it is an actual contract, and basically you're saying, for example, if you want to buy a bunch of Tesco shares, instead of buying the Tesco shares, you're basically agreeing with your broker that if he buys these shares for you on your behalf, you will pay the difference between the price that you buy them at and the sell price if that's a negative difference, and he will agree to pay you the difference if it's a positive difference between the buy price and the sell price. So in other words, in simplified terms, if you're buying a bunch of Tesco shares via a CFD, a contract for difference, and they go up in price, the broker will pay you the difference between the sale price and the buy price, and if they go down in price, you agree to pay the difference between the sale price and the buy price. That is really, in a broad nutshell, what it's all about. We'll go to a lot more depth in a second, but ultimately that's what it is. You're not buying the underlying asset, so you don't get any voting rights. CFD is purely mirroring the underlying via a specific contract, and you different types of dividend payouts. You do get dividend payouts, but they're slightly different the way it works with them because it's not the actual underlying, and there's a middleman involved, i.e. your broker. You're not going directly to the exchange as such. There's an extra layer of complexity in there, so they're slightly different. The one thing to remind you is that if you're trading an asset, the CFD will track the underlying asset. So if you're trading Tesco CFDs, they will track the Tesco shares identically. If you're trading Facebook CFDs, they will track Facebook stock identically. There are some additional costs that go into it, but ultimately speaking, the value is based on an underlying asset. But we'll talk more about that in a second. So, how do they work? Now, basically, no one's writing out a full legal contract every time we're looking to place a trade. It's all automated, and obviously when you open your brokerage account, you've got the reams and reams of paperwork that you generally have with the accounts, or if you're doing it online, loads of terms and conditions, and in there it's basically saying to you, listen, when you open a trade, you are opening a new contract with us. You're forming a new contract with us as the broker, and these are the terms of the contract. So they're going to say to you, listen, it's based on your account value. It's based on the requested size of the CFD you want to buy. So if you want to buy an awful lot of shares, an awful high valuation, that's going to be different parameters in the contract. And if you want to buy a small valuation, it's going to be based on the price of the asset you're buying. So if you want to buy one share, one CFD, should I say, of Tesco, it's going to be different compared to if I want to buy 100,000 CFDs of Tesco. And the definition of a CFD, now this is broadly speaking the same, and we'll cover this in a couple of videos later, but ultimately they just want to confirm what a one CFD is. Now, some brokers are different, but generally speaking, and again, we will go to a bit more depth in a second, but one CFD is equal to £1 or 1 unit. So if you're buying one CFD of Tesco, you're basically buying one share of Tesco. That's generally how it is. If you're buying an index, it's just, as I say, it's £1 times the notional value. And if you're buying a commodity, now you've got to just double check this because some brokers, one CFD will be £10 if you're buying an index. So it's £10 in notional value. Go into a lot more depth in a second. So what your trading goals are. So ultimately you're going to go long or short. You're looking to profit if the market goes higher, or you're looking to profit if the market goes lower. That's going to depend on what kind of CFD is written up automatically there, and who pays who under what conditions. And obviously, your risk tolerance in terms of that's going to dictate whether you're putting a stop loss in and how much margin you're putting up and all those kind of things. So this is, as I say, it's done automatically. No one's writing this out. It's just an agreed thing when you open the account. If you open a trade, a contract is going to be formed. And that's going to depend on whether you're buying or selling the CFD, the size of the position of the CFD, the underlying instrument, and hence the total value of the CFD. For example, one share of Tesco versus one share of Amazon or Apple, complete different valuations, so the CFD is going to be adjusted to suit. The definition, obviously, deep down in the terms, and you'll understand that right at the beginning. Your trading goals, whether you're looking to profit if the market goes higher, or if that stock goes higher, or if the stock goes lower, and your risk tolerance to the trade. So all those parameters go into forming the CFD.